One of the world's largest automakers now says it is facing massive losses, due in part to U.S. tariffs. So Stellantis makes Chrysler, Jeep, Dodge vehicles, and it's now saying it lost $3.7 billion Canadian. We're just talking in the first half of 2025.
Stellantis went from making billions in profit to losing roughly $26 billion in a single year. That loss was big enough to wipe out years of earnings. The company had to cancel its dividend, stop paying cash to shareholders, and then go out and borrow billions on the bond markets just to keep its balance sheet solid. We are not talking about small brands. This is the group behind Fiat, Alfa Romeo, Maserati, Vauxhall, Chrysler, Dodge, Ram, Jeep, and many more. 14 brands in total. Some are over 100 years old. In this video, I want to walk through how a company that big, owning so many famous names, managed to get itself into a position where it had to admit a loss this huge, and what that has done to the brands you actually see on the road, and the ones you might have owned yourself.
The failed plan. As most of us remember, in early 2021, French group PSA and Fiat Chrysler automobiles combined to form Stellantis. Overnight, all those brands ended up in one basket. The person in charge was Carlos Tavares. He had already rescued PSA once by slashing costs, simplifying the range, and making factories more efficient. His plan for this new, larger group was basically the same, just on a much bigger scale. The car industry is expensive. Creating a new platform, the basic structure under a car, can cost billions. The same for a new engine family or a new electrical system. So the logic was simple. Instead of 14 brands all doing their own engineering, you design a small number of flexible platforms and engines. Then you spread them across Fiat, Peugeot, Opel, Vauxhall, Jeep, and the rest. Same bones, different bodies. At first, it worked. Stellantis reported strong margins. Investors and analysts praised it as one of the leanest, most efficient manufacturers out there. The problem is what happens when you push that idea too far. If you share too much and do not spend enough making each brand feel distinct, the differences shrink. An Alfa becomes a slightly sportier Peugeot. A Maserati feels like a dressed-up mainstream sport utility vehicle. A Vauxhall feels like the European cousin of something you have already seen wearing 3 other badges. Platform sharing itself is not the villain here. Volkswagen Group has done it for years. The issue is when it becomes the only real focus, and brand identity and product quality are treated as optional extras. That trade-off did not matter much while profits were rising. But then, Stellantis placed another big bet, on top of all this cost-cutting. And that is where things really started to unravel.
The risky electric push. While Stellantis was busy sharing platforms, the whole industry was being pushed towards electric vehicles. Governments in Europe, the United Kingdom, and elsewhere talked about deadlines to end new petrol and diesel sales. Emissions rules tightened. Investors wanted every car maker to tell a convincing electric story. So Stellantis did what almost everyone expected. It promised a rapid shift to electric. It committed billions to new battery electric platforms, battery factories, and retooled plants. It talked about a future where a huge share of its sales would come from plug-in cars. On a slide deck, it made perfect sense. Regulators were demanding cleaner fleets. Rival groups like Volkswagen were doing similar things. If the world was going electric anyway, better to have the capacity ready. The problem is that reality did not match those very optimistic curves. Electric vehicle demand did grow, but in many markets it did not grow fast enough to fill all the capacity that had been planned.
In parts of Europe, incentives helped, but in the United States of America, where Stellantis relies heavily on Jeep, Ram, Dodge, and Chrysler, things were messy. Buyers liked trucks and sport utility vehicles. They worried about charging, range, and price. The political mood shifted. Some states pushed electric vehicles. Others pushed back against them. Electric vehicles themselves are not the mistake here. The mistake was assuming that buyers in every region would move at more or less the same speed, and investing as if that was a sure thing.
So Stellantis ended up in a position where it had spent heavily on factories and platforms for a future that was arriving more slowly and unevenly than planned. And at the same time, the present began to show cracks in other places. While we are talking about this, let me know in the comments where you stand. Are you still confident in these brands, or have you quietly crossed them off your list? Your stories are usually a lot more honest than the marketing. Warning signs everywhere. By 2024, Stellantis was still profitable, with more than 5 billion euros of net profit, but the mood had changed. The most obvious warning sign came from its own dealers in the United States of America. A group of them published an open letter accusing the company of pushing prices so high that vehicles were sitting unsold on lots. They complained about quality issues. They talked about leadership that seemed more interested in squeezing short-term numbers than in keeping brands healthy. Dealers always complain about something, but going public like that in one of Stellantis' most important markets was unusual. It showed how much pressure there was further down the chain. Inside the company, the board could also see that the growth story was running out of road. Profits were positive, but heading the wrong way. Some brands were clearly underperforming. The electric investments were not producing the returns that had been promised. At the end of 2024, they pushed out Carlos Tavares. That is not something you do lightly to a chief executive who has just delivered billions in profit. It tells you they were looking at the next few years and did not like what they saw. A new chief executive, Antonio Filosa, took over during 2025. His job was not to pretend everything was fine. His job was to open up the books, admit what was not working, and reset expectations. When the full year results for 2025 came out, everyone could finally see the size of the hole. The loss laid bare. The number that grabbed headlines was simple and brutal. A net loss of roughly around $26 billion for the year 2025, the first annual loss in the history of Stellantis. It is worth briefly breaking down what that means. First, more than 25 billion euros of that was made up of write-downs. That is the company effectively saying, we told you these assets were worth this much, but based on what we now expect to earn from them in future, they are actually worth less. That can include factory capacity that will not be fully used, electric vehicle platforms that will not generate the volume or profit originally forecast, and even the assumed value of certain brands or business units. So a big part of the loss is Stellantis and Antonio Filosa admitting in one painful year that the future is not going to be as profitable as the previous leadership had promised. But not all of it is just an accounting adjustment. The company also flipped from an operating profit to an operating loss. Revenue slipped to around 153 billion euros. Cash flow turned negative. On top of that, tariffs and trade barriers, especially on European-built vehicles headed to the United States of America, put extra pressure on margins. To protect itself, Stellantis suspended its dividend for 2026, something shareholders hate, and announced plans to issue up to 5 billion euros of bonds. In simple terms, it stopped paying cash out and started pulling more cash in to strengthen the balance sheet. That is not what a confident, relaxed global carmaker does. That is what a company in trouble does when it finally has to show everybody the real numbers. But those numbers are only half the story. To really understand how we got here and what it means, you have to look at what is happening brand by brand. Prestige brands in trouble. Let us start with the badges that are meant to be aspirational. Maserati should be a star, Italian, glamorous, fast, the kind of brand that lifts the whole group. Instead, it has been stumbling. Underinvestment, changing plans, electric projects that were announced and then scaled back, and falling sales have left Maserati closer to being a problem child than a flagship. It is not obvious what Stellantis wants it to be in 10 years' time. Alfa Romeo is another emotional name. For enthusiasts, it is style and racing history. Under Stellantis, Alfa has had some good-looking cars, but it has also sat near the bottom of many independent reliability surveys. That sort of reputation puts a ceiling on how far you can push pricing, no matter how pretty the product is.
The Milano naming mess, where a car called Milano had to be renamed because it was built in Poland and the Italian government objected, sounds small on its own, but it underlines how messy things can get when the marketing story and the reality of the product do not line up.
Lancia once built rally legends and innovative family cars. For years now, it has been reduced to effectively one model, sold mainly in Italy. Stellantis has floated revival ideas, but in practice, Lancia has been left as a ghost brand, alive on paper, barely present in showrooms. DS Automobiles is the opposite case. Stellantis tried to create a premium French brand from scratch, without the decades of history that others have. The cars use mainstream platforms underneath, with more upscale interiors on top. Buyers so far have not really been convinced. Sales are modest. Used values fall quickly, because the market does not see DS as truly premium. All of these point to the same thing. Stellantis has either not invested enough or not invested in the right way to give these brands a clear, believable future. They tie up management time and capital, but they do not add enough to the group to justify the effort. And while that hurts the image at the top, the deeper, more expensive trouble is happening lower down in the range. Everyday brands slipping. For Stellantis, the real money is supposed to come from the everyday brands: Peugeot, Citroën, Vauxhall, Opel, Fiat, and the rest. These are the cars people buy for commuting, school runs, and small businesses. One of the clearest own goals here is the small 3-cylinder petrol engine used widely across Peugeot, Citroën, Opel, Vauxhall, and DS. Many of you will know it as the Pure Tech engine. When it came out, it picked up awards and praise for its efficiency. Then a serious issue surfaced. The timing belt on this engine runs inside the engine oil. Over time, on some cars, that belt can break down. Bits of it can clog the oil pickup. When that happens, the engine is starved of oil and can seize. These are not just ancient, abused cars. Some failures have happened on vehicles only a few years old. Owners have been left with huge repair bills, sometimes bigger than the value of the car itself. In France, there has already been legal action. Stellantis has extended warranties in some cases and offered goodwill repairs in others, but that still leaves a lot of unhappy customers. And in a segment where buyers value simple, dependable transport above all else, that kind of scandal sticks. Then there is the manufacturing side. In the drive for efficiency, Stellantis has closed or reshaped plants, including in the United Kingdom and continental Europe, affecting Vauxhall and Opel. On a balance sheet, that is about removing excess capacity. On the ground, it is about communities losing long-term employers and seeing local brands feel less local. Fiat is another example. Once the default choice in Italy, with iconic models like the original 500 and the Panda, it now has a much smaller and more confused range. The modern electric 500 looked like the right car at the right time, but its pricing was high compared to what many buyers were willing to pay, and demand did not meet expectations. Production had to be paused more than once because the orders simply were not there. Taken together, you have everyday brands dealing with engine issues, plant closures, and unclear lineups at the exact moment when Stellantis needed them to be rock solid. That would be bad enough on its own. But remember, this is all happening while the rest of the industry is also under pressure. Industry déjà vu. It is easy to look at Stellantis and think it is uniquely chaotic. In some ways, it is just the loudest example of a wider pattern. Volkswagen Group has had its own problems. It bet heavily on shared platforms and a fast move to electric vehicles. Then it ran into software delays, quality concerns, and a market that was not quite as ready as expected. Targets had to be pushed back. Investments had to be reconsidered. Porsche, famous for very high profit margins, also talked a big game on electrification, and is now trying to balance that with the realities of buyer demand and the cost of all that new technology. The pattern is similar across many big players. Deep cost-cutting and platform sharing are pushed very hard to please investors, Big public commitments are made to electric vehicles to satisfy regulators and markets. The hope is that brand loyalty and clever marketing will carry buyers along, even if the products are not perfect or the timing is off. What Stellantis shows us is what happens when you run that playbook across 14 brands at once. If it works, you look like a genius. If it does not, you end up with a huge write-off, stressed dealers, nervous investors, and a lot of bruised brand reputations. So, can Stellantis actually pull itself out of this? Or is this the start of a slow decline? Can Stellantis recover? Under Antonio Filosa, Stellantis has started to change course. The message is less. Everything must be electric as fast as possible. And more, we will give different markets a mix of petrol, hybrid, and electric that matches what people are actually buying.
In practice, that means electric vehicles will still be a big focus in Europe, where rules and incentives push that way. But in places like North America, internal combustion engines and hybrids will stay important for much longer. The group is also relying heavily on Jeep and Ram. Those brands still have clear identities, decent pricing power, and strong demand for sport utility vehicles and pickup trucks. If Stellantis can keep those two healthy, they provide the cash and stability to work on the problem areas. Financially, there have been some small, cautious positives. In the second half of 2025 and early 2026, revenue stopped sliding and edged up a little. The company talks about returning to profitable growth and closing the gaps left by the previous strategy. But that does not magically repair years of damage. Maserati still needs a clear, funded plan. Alfa Romeo needs to prove it can build cars that are as reliable as they are attractive. Fiat needs more than nostalgia to keep selling. Vauxhall, Opel, Peugeot, and Citroën need to convince buyers that their cars are solid, not just clever on paper.
In the end, this is not a one-year story. Even if the $26 billion loss is a big one-off cleanup, the real test is whether people start buying these brands again, and then come back for a second and third car. That is what will decide whether Stellantis is a comeback story or a slow fade. What it means for drivers. If you strip it down, Stellantis was not sunk by one single thing. It was not just electric vehicles. It was not just cost cutting. It was the belief that you could merge 14 very different brands, squeeze out as much cost as possible, bet heavily on a future technology, and assume that customers would mostly accept it because the badges were familiar. People noticed more than that. They noticed when their new car felt cheaper than the old one, even if the price was higher. They noticed when engines failed too early. They noticed when a supposedly premium badge did not feel much different from a cheaper cousin.
Once that feeling spreads, size does not protect you. Being the fourth largest car maker in the world did not stop Stellantis from having to admit a huge loss, cancel its dividend, and raise fresh debt. Scale only makes the fall louder. Can Stellantis fix it? Maybe. Other companies have pulled off turnarounds after bad bets. But it will not be quick, and it will not be solved by one press conference. It will depend on whether, over the next few years, the cars they build are genuinely better, and whether buyers like you are willing to give those brands another chance. So I want to hear from you. If you have owned Fiat, Alfa Romeo, Maserati, Vauxhall, Opel, Peugeot, Citroën, Jeep, Chrysler, or Dodge, what has your experience been? Did the quality change over time? Would you buy from that brand again? Because between everyone watching this, we probably cover every badge inside Stellantis. Your stories are often a better guide to what is really happening than the official numbers. And if you think a $26 billion loss is as bad as it gets, there is another story coming. It is about one of the most worshipped names in motoring, a brand people dream about owning. And it is starting to face some very similar pressures, just in a quieter, more dangerous way. We will get into that next time. Until then, I want to hear from you. If you have owned any of these cars, Fiat, Alfa Romeo, Maserati, Vauxhall, Opel, Peugeot, Citroën, Jeep,
Chrysler, Dodge? What has your experience actually been like? Did they win you over or put you off for good? Let me know in the comments, because those real stories tell us more than any annual report. If you found this useful, please hit like and subscribe with notifications on so you do not miss that next deep dive when it drops.